Every quarter, a company reports earnings. The stock moves 5%, 10%, sometimes 20% in a single day, and most investors are completely caught off guard. But here's the thing, earnings surprises are not random. There are signals in the data before the report ever comes out. Today, I'm going to show you a 3-prompt AI system that helps you spot those signals before the market does. Welcome to the AI portfolio. Every week, I show everyday investors how to use AI tools to research stocks smarter and faster. I'm not a financial advisor. Nothing here is financial advice, and you should always do your own research before making any investment decisions. This is not about predicting the future with certainty. It's about reading the signals the market is already giving you before the crowd notices them. Before we get into the prompts, let's understand why earnings surprises happen at all. Analysts publish estimates. Those estimates are based on models, management guidance, and industry data, but those models can be wrong, sometimes systematically wrong, and in predictable ways. Companies that have beaten estimates for 3 or 4 consecutive quarters tend to be run conservatively. Management sandbagging guidance is real. They deliberately set the bar low so they can step over it. Meanwhile, sectors that are seeing rapid cost improvement often surprise on margin. The signals are there if you know where to look. Before you start, you need 3 things. First, the analyst consensus estimate for the upcoming quarter, revenue and earnings per share. You can find this on Seeking Alpha, Yahoo Finance, or FinViz. Second, the company's last 2 or 3 earnings reports, which are publicly available in their investor relations section. Third, any recent management commentary from the last earnings, call transcript, or a recent investor presentation. Once you have those, you're ready to run the 3 prompts. Here's prompt 1. Based on management's most recent guidance and the current analyst consensus estimate, identify any gap between what management said they expect and what analysts are modeling. Is management guiding above or below consensus? Has management historically beaten their own guidance? What does this guidance pattern suggest about the likelihood of an earnings beat or miss? What you're looking for here is the guidance gap. When management guides to $2 per share and analysts are modeling $2.15, that's a setup. When management has beaten their own guidance in 7 of the last 8 quarters, that pattern matters. Prompt 2 focuses on the business trajectory leading into the quarter. Based on the most recent earnings reports and any available industry data, identify the key operational trends heading into the upcoming quarter. Is revenue acceleration or deceleration evident? Are gross margins expanding or contracting? Is the company gaining or losing market share? What does the trend in these metrics suggest about whether the upcoming quarter will beat, meet, or miss current estimates? The key insight here is that businesses don't usually turn on a dime. A company that has shown accelerating revenue for 2 consecutive quarters is more likely to accelerate again than to suddenly slow down. The trend is your friend until it isn't. The whisper number is what sophisticated investors actually expect, distinct from the published consensus. It reflects private conversations, recent data points, and the actual positioning of money. Here's prompt 3. Based on recent analyst commentary, any pre-announcement signals, and the company's historical beat rate, estimate a plausible whisper number for the upcoming quarter, the figure that a beat or miss would actually be measured against. Is the whisper meaningfully different from the published consensus? What are the 1 or 2 specific factors most likely to drive results above or below expectations? A stock can beat the published consensus and still sell off if it misses the whisper. Understanding this gap is often the difference between a good trade and a confusing one. Here's how the 3 prompts work as a system. Prompt 1 tells you what management is signaling versus what analysts expect. Prompt 2 tells you whether the business momentum heading into the quarter supports an upside surprise. Prompt 3 tells you what the real bar is, not the published number, but the actual expectation that matters. When all three point in the same direction, management guiding conservatively, business momentum accelerating, whisper above consensus. That's a meaningful setup. When they conflict, that's information too. It tells you the situation is uncertain and the risk is higher. Let me be clear about the limits of this system. Macro shocks can override everything. A surprise interest rate decision or a geopolitical event can make even a perfect earnings beat irrelevant if the market is in sell mode. One-time items, legal settlements, write-downs, restructuring charges can distort the headline number in ways that AI analysis won't catch without the right context. And guidance can simply be wrong, especially for companies with high revenue visibility, but volatile cost structures. Use this system as a lens, not an oracle. It improves your odds. It does not guarantee outcomes. Your homework this week: pick one company reporting earnings in the next 2 to 4 weeks. Find the analyst consensus, pull the last 2 earnings reports, and grab the most recent earnings call transcript. Run all 3 prompts. Do you see a guidance gap? Is the business momentum pointing up or down? And is the real bar different from what the street is publishing? If you do this consistently, you will stop being caught off guard by earnings surprises. You'll start seeing them coming. That's it for episode 20. Subscribe for a new video every week on AI and investing in plain English. See you next time.